This is the story of how Medicare charges higher-income seniors extra money for their health coverage, and why 7% of Medicare beneficiaries now pay between $74 and $443 more each month than everyone else. Most people think Medicare has one price, that you turn 65 and pay your Part B premium, and that's the end of it. But in 2025, about 5.1 million Medicare beneficiaries opened letters from the Social Security Administration and learned something different. Their Medicare premium would cost more because of something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount, which is a surcharge added to your Medicare Part B and Part D premiums when your income exceeds certain thresholds. The Social Security Administration figures out who pays by looking at your tax returns from 2 years back, so for 2025 they're using your 2023 income, and for 2026 they'll use what you made in 2024. Here's how it works in California. The standard Medicare Part B premium in 2025 comes to $185 per month, but if you're filing single and your modified adjusted gross income in 2023 topped $106,000, you pay more. Married couples filing jointly hit the threshold at $212,000. The surcharge isn't pocket change. At the first income bracket above the threshold, you're paying an extra $74 monthly, bringing your total Part B premium to $259. Single filers earning $500,000 or more pay an additional $443.90 per month at the highest bracket, which pushes their total Part B premium to $628.90. This hits about 7% of Medicare's 69 million enrollees according to the Medicare Trustees Report, and about 4.4 million beneficiaries also paid IRMAA surcharges for their Part D prescription drug coverage. The income brackets operate on a sliding scale. For single filers in 2025, if your 2023 income landed between $106,000 and $133,000, you pay $259 total. Income between $133,000 and $167,000 puts you at $333, while $167,000 to $200,000 means you pay $406.90. $200,000 to $500,000 costs $480.80, and anything above $500,000 hits the maximum of $628.90. Joint filers face different thresholds but get charged the same surcharge amounts. Income between $212,000 and $266,000 means you pay $259 total, while $266,000 to $334,000 brings you to $333. $334,000 to $400,000 costs $406.90, $400,000 to $750,000 runs $480.80, and anything above $750,000 puts you at the maximum. Married couples who file separately but live together at any time during the year face steeper adjustments. Income greater than $106,000 but less than $394,000 means your total premium is $406.90, and above $394,000 you hit the maximum of $628.90. Part D prescription drug coverage carries IRMAA too, with income brackets identical to Part B but different surcharge amounts. The average Part D premium sits at $46.50 per month in 2025, and you must pay Part D IRMAA directly to Medicare rather than to your plan or employer. Part B IRMAA gets automatically deducted from your Social Security benefits, or you can pay through Medicare Easy Pay, by mail, or online. The 2-year lookback creates situations where what you're paying doesn't match your current income. Selling property or taking a large retirement account distribution in 2023 means you'll pay higher IRMAA in 2025 even when your 2024 and 2025 income drops back down. The upside is IRMAA recalculates every year, so when your income falls, your IRMAA automatically falls the following year. You can appeal IRMAA when your circumstances change. The Social Security Administration accepts appeals for life-changing events including loss of income, death of a spouse, marriage, divorce, work reduction, or loss of income-producing property, and you can also appeal when the tax information they used was incorrect or outdated. You have 60 days from receiving the IRMAA notice to file an appeal by contacting the SSA at 800,772-1213, Monday through Friday from 8 a.m. to 7 p.m. local time. For California seniors, IRMAA sits on top of an already expensive tax environment. California charges state income taxes ranging from 1% to 13.3%. Doesn't tax Social Security benefits but does tax all other retirement income, which means withdrawals from 401k accounts, pensions, and traditional IRAs get fully taxed. Property taxes stay relatively low thanks to Proposition 13, but home values remain high. This creates planning challenges because when you're managing income to stay below IRMAA thresholds, you need to account for both federal and California state taxes. A withdrawal that pushes you into a higher IRMAA bracket costs you twice, first in Medicare premiums and again in California income tax. Some strategies can help you avoid or reduce IRMAA. The most direct approach is keeping your modified adjusted gross income below the thresholds, which for many retirees means being strategic about which accounts you withdraw from. Roth IRA withdrawals don't count as taxable income and won't affect your MAGI, while traditional IRA and 401k withdrawals do count. Timing matters when you're planning a Roth conversion. Doing it in a year when your income is already high might not trigger additional IRMAA if you're already in a high bracket, but converting in a year when you're just below a threshold could push you into the next bracket and cost you extra for the next 2 Medicare years. Qualified charitable distributions offer another option. Reaching 70 and a half or older means you can donate up to $108,000 annually from your IRA directly to charity, and these distributions satisfy your required minimum distribution without counting as taxable income. They won't trigger or increase IRMAA. You can still take the standard deduction even though you made a charitable gift, and starting in 2025 you can also make a one-time QCD of up to $54,000 to a charitable gift annuity, which provides you with a predictable income stream. Delaying Social Security can help too. Taking Social Security later increases your monthly benefit, and in the years before you claim, that income isn't counting toward your MAGI, so some retirees use this window to do Roth conversions or take larger traditional IRA withdrawals while they're not yet receiving Social Security income. Tax bracket optimization is another strategy. For joint filers in 2025, the 24% federal tax bracket tops out at $394,600 of taxable ordinary income, and when you add the combined standard deduction of $34,700 for senior joint filers, you can have up to $429,300 of gross ordinary income before hitting the 32% bracket. Some financial advisors call this filling up the bracket, where you take enough withdrawals to use the 24% space without crossing into higher territory, which helps reduce future required minimum distributions and potentially future IRMAA. California state and CSU retirees enrolled in CalPERS Medicare health plans can get help with IRMAA costs. CalPERS may reimburse the Part B premium including IRMAA surcharges when you submit a copy of your SSA notice showing the IRMAA determination to CalPERS, though processing takes up to 60 calendar days and the reimbursement can't exceed the difference between the employer contribution and your health plan's premium cost. The IRMAA amounts change every year. From 2024 to 2025, the standard Part B premium increased $10.60, and the IRMAA income brackets increased by almost 3%. For 2026, the standard Part B premium jumps to $202.90, an increase of $17.90 from 2025, and the income thresholds also rise. Single filers see the starting point move from $106,000 to $109,000, while joint filers see it move from $212,000 to $218,000. These annual adjustments mean your IRMAA status can change even when your income stays relatively flat. Income growing slower than the bracket adjustments might drop you into a lower IRMAA tier, while income growing faster could move you up. One development that caught some retirees by surprise was the Social Security Fairness Act. Public sector retirees who received benefit increases from this legislation might see IRMAA triggered in 2026 or 2027 based on their higher 2024 or 2025 income, which is a case where getting more Social Security income could increase your Medicare costs 2 years later. IRMAA revenue goes into the Medicare budget and helps keep the program financially stable for all seniors. The surcharges from higher income beneficiaries offset costs and reduce the burden on the general Medicare population, with about 93% of Medicare beneficiaries paying just the standard premium while the 7% paying IRMAA fund a larger share. The system assumes that people with higher incomes can afford to pay more for their health coverage. Whether you agree with that philosophy or not, understanding how IRMAA works lets you make better financial decisions, because knowing that a large withdrawal today will affect your Medicare premiums 2 years from now changes how you think about retirement account timing. Some people assume that once they start paying IRMAA, they'll always pay it. That's wrong because IRMAA recalculates every single year based on your income from 2 years prior. So having 1 year with high income from selling a rental property means you'll pay higher IRMAA for 1 year, and when that income drops off the 2-year lookback, so does the surcharge. For California seniors worried about finances, IRMAA represents another layer of cost to manage. You're already dealing with California's high income tax rates, property taxes, and the general cost of living, and adding hundreds of dollars per month to Medicare premiums can strain a fixed income. But unlike many expenses, IRMAA is somewhat controllable through income planning. The key is looking ahead. Turning 63 and planning retirement account withdrawals means remembering that those withdrawals will affect your Medicare premiums when you're 65. Doing a home sale or taking a pension lump sum requires factoring in the IRMAA impact 2 years later, and considering whether to delay Social Security means accounting for how that affects your taxable income during the delay period. IRMAA doesn't make retirement planning simple, but it follows predictable rules. Income from 2 years ago determines this year's surcharge, the brackets are published, the appeal process exists for legitimate life changes, and the surcharge adjusts annually as your income changes. None of this is hidden or arbitrary. For the 5.1 million Medicare beneficiaries paying IRMAA in 2025, the surcharge is real money. An extra $300 per month adds up to $3,600 per year, and over 10 years in retirement that's $36,000. Couples where both spouses have IRMAA should double those numbers, and these aren't trivial amounts for most retirees. The solution isn't to avoid Medicare because you need health coverage and Medicare is what's available. The solution is understanding that Medicare premiums aren't fixed and planning accordingly, which might mean spreading large withdrawals across multiple years to avoid bracket jumps, using Roth accounts strategically, delaying Social Security to create a window for higher withdrawals before Medicare starts, or doing charitable giving through QCDs to reduce taxable income. What it definitely means is knowing that 7% of Medicare beneficiaries pay more than the standard premium, and that whether you're in that 7% depends on decisions you make about income 2 years in advance.